to stick with the Bank of Canada rate cut of earlier this week and explore the implications for the country's housing market. Our next guest thinks that several cuts may be needed before we see a substantial pickup in activity in the market, a release of pent-up demand. We're joined by Robert Hogue, Assistant Chief Economist at the Royal Bank of Canada. He joins us, as you can see right now. Robert, thanks a lot. Talk to us about the expected path of interest rates. I think everybody, you can tell us what your view is and your colleagues' view, the expected trajectory now of the Bank of Canada. I think everybody has stepped up their expectations. We now expect a fairly direct path downward on interest rates. And what will this mean to the Canadian housing market?
Right, and our view is, I think, is probably on consensus, or consensus caught up with us. Now we're expecting a couple more cuts this year, and four rate cuts of 25 basis points next year. So basically, from beginning to end, like 200 basis points worth of cuts, and leaving the overnight rate at 3% in latter stages of 2025. So. This will, in our view, over time, it will stimulate the demand for home ownership, for housing. But that will be more of a gradual process in our view. I think it will need, as you pointed out, we will need several rate cuts to make a difference for a lot of folks who are sitting on the sidelines here, waiting for the right moment to get into the housing market. Housing affordability is still a huge issue, and this is true in expensive markets. It's also true in many places, in smaller markets across Canada as well. So we need, the interest rate need to come down much more materially to make a difference, to open the door for those who are on the sidelines at this stage.
In early 2023, as you recall, many viewers will recall, the Bank of Canada, which was at that point on its way up, it was near the end, but not yet finished raising interest rates. It actually paused in early 2023. And we remember that pause, simply the Bank of Canada not raising interest rates, spurred a lot of activity in the housing market. What has changed in the market now? You're now telling us that even a couple of cuts are not going to spur activity in the market.
Right. And this time we've seen this spring the market did not really take off or rebound materially, and not that much since the first rate cut by the Bank of Canada in June. And at the time, if you go back, what we had seen was still bond markets was starting to price in a bit more rate cuts on the parts of central banks, not just here in Canada, but elsewhere as well. So we had seen some, to a certain extent, a little bit of a decline in some of the fixed mortgage rates at the time. So that might have, plus the rhetoric of the Bank of Canada starting to signal that they would start to pivot potentially last year. So that kind of contributed to this expectations that the market will, the conditions would improve for the market, and we had seen at the time some buyers probably trying to jump ahead of the market, but that proved to be very short-lived. Obviously, with the Bank of Canada resuming rate hikes in June and July of last year, that really cooled things off and led to another kind of a period of a bit of a correction. And we had seen that translating to lower prices in the summer in early fall of last year. But now things, as the Bank of Canada is now embarked on a rate cutting, March for the next little while, we think that it will take some time, because we've seen bond yields not reacting that much recently. And fixed mortgage rates have not budged that much either. So that means that in terms of, for those looking for the lowest mortgage rates in the market, things have not changed much since June. So I think we need to see further rate cuts by the Bank of Canada, bond yields moving lower, and fixed mortgage rates to move lower as well to get things going a bit more.
You say there's a significant lack of affordability in the market. That's the main stumbling block to activity. Will lower rates in and of themselves help affordability?
They will. The question is, will they? Will they need? Will they help sufficiently? And this is the big issue. I think a quarter point cuts will not make that material a difference. I think once we're looking something closer to a full 100 basis points of drop in interest rate. I think this is where you might start to see some easing in affordability conditions. Enough so to make a difference. Now, anyone hoping that the affordability will be back to pre-pandemic levels, I think, should temper their expectation. I think we're still far away from that.